In our previous Chapter 3 video, we developed a simple framework for thinking about various sources and uses of cash within a company. In this video, we're going to use that framework to better understand how to construct our third major financial statement, which is our statement of cash flows. Our statement of cash flows acts as a summary of the various sources and uses of cash that we've already discussed. That summary is typically divided into three major categories. The first category is our operating activity, which pertains to the day-to-day operations of the firm. The most important value in that category being our net income, but we also want to consider adjustments for non-cash items and our current asset and current liability accounts. Our next category is our investment activity, which pertains to changes to our net fixed assets. And finally, we consider our financing activity, which really pertains to how it is that we paid for this investment activity. So there we look at changes to various liability accounts, equity accounts, and we also consider our dividend policy. So for each of these categories, we will be using data from both the income statement and the balance sheet that we looked at for our sample company in a previous video, because we're going to consider the same sample company. So those statements are available on the OWL website. I'd like you to make sure that you've got them accessible so that you can follow along on this video. So here is our sample statement of cash flows for our sample company. The first thing that we recognize, as always, is that each value on our statement represents a change over time. And so therefore this statement reflects flow variables over a particular period. In this case, we're looking at a period again of 1 year ending at the end of 2019. If we've constructed our statement properly, we should be able to tell how it is that we went from a starting cash balance of $6,489,000 to an ending cash balance of $3,171,000, which is somewhat lower. Now we have used the indirect method to construct this cash flow statement, which basically just means that we start with our net income and then we make various adjustments to there to reflect non-cash items and changes to relevant asset, liability, and equity accounts. So we begin with our operating activity, and again, the first cash flow that we consider is the net income from our income statement. But we right away want to recognize that in order to calculate net income, we had to deduct depreciation, and you can see that from the income statement. But recall that depreciation expense is a non-cash expense, which means we didn't have to write a check for that amount. So that cash is still available to us. So we want to make an adjustment to add back that amount to reflect that we still have that cash in the company. The next thing we want to look at is the changes to all of our current accounts. And to calculate each of these numbers, as well as the other numbers, changes to the other accounts, what we're going to do is look at the balance sheet for each account, and we're going to see how the number changed from the end of 2018 to the end of 2019. So we're interested in both the amount of the change and whether it was an increase or a decrease. So if we look at our other current liabilities, we notice that there was an increase over the course of the year of $141,049,000. And since this was an increase to a liability account, we know that that represents a source of cash, which is why this number is positive. Next, we look at the accounts receivable, inventory, and other current assets accounts. So these are all three current assets, and in all three cases, the asset increased by these respective amounts. Again, because we are looking at an increase in asset accounts, we know that that represents a use of cash, which is why all three of these numbers are negative. Finally, we look at how our accounts payable changed. In this case, it decreased by just under $27 million. And again, since it is a decrease in a liability account, that represents a use of cash, and so we have a negative number. So if we add up all of our sources and uses of cash, we have our net cash from operations of $726,387,000. Next, we look at our investment activity. And in this context, we're not talking about investment in things like Tesla stock or NEO or Nikola. Here we are talking about net investment in fixed assets, or more specifically, our fixed asset acquisition. Now, on our statement here, we seem to have calculated a total net acquisition of $957,007,000. So that was the amount of cash that was used to buy new fixed assets. But we want to investigate this a little bit closer to determine how we calculated this. If we look back to our balance sheet and we look at the two numbers for net fixed assets, we notice that from the end of 2018 to 2019, we see an increase in that account of $594,682,000. And this is a very different number than the $957 million number that we have on our cash flow statement. So how can we reconcile this? In particular, what we're wondering is, how is it that we went from this number here to this number here? So that's the calculation we now have to look at. In order to move from our beginning net fixed assets to our ending net fixed assets, two things happened. The first thing is we bought some stuff. The second thing is we recorded some depreciation. Now, the stuff that we bought increased the value of our account, and the depreciation decreased the value of our account. So this is a very simple equation, but notice our financial statements only give us 3 out of the 4 numbers that we need. So we know our beginning and our ending net fixed assets from our balance sheet. We know our depreciation amount from our income statement, but we didn't have this amount here. But that's okay. Given a simple equation with only 4 variables and only one of them being unknown, we can easily solve for that fourth. So if we rearrange this equation to solve for net fixed asset acquisitions, we have this algebra down here. So the amount of the acquisition is equal to our ending net fixed assets minus our beginning net fixed assets plus our depreciation. And that's how we arrived at our net acquisition of $957,007,000. Finally, we want to look at our financing activity. So we notice that for both of our notes payable and our long-term debt, we saw substantial increases in each of these accounts. And again, since each of these accounts are liability accounts, those increases represent sources of cash. We borrowed that money, so it's now available for us to use. We also remember from our balance sheet in a previous video that this company, for some reason, reduced the common share equity by repurchasing shares. And since that's a deduction or a reduction in our equity account, that represents a use of cash. Finally, we had a very important use of cash, being the almost $400 million paid in dividends. So if we add up all the various sources and uses on the financing side, we arrive at our total net cash from financing of $227,302,000. Now at this point, students may wonder, why is it that we considered the change to the common share account, so that portion of the equity component of our balance sheet, but we didn't consider the change to our retained earnings, which is another important portion of our equity component of the balance sheet. If you're wondering that right now, you may wish to pause this video and give that question some extra thought. So is it the case that we actually forgot to count the change to our retained earnings in constructing our statement of cash flows? The answer is no. So recall, we have already counted our net income as a substantial positive cash flow here. We have also already accounted for the substantial amount of dividends that we paid. And remember, it's the difference between our net income and our dividends that's equal to our increase in retained earnings. So we have already accounted for that amount on this financial statement. So to summarize here, we can take the total net cash flows from each of the 3 categories that we've considered. If we add them all up, we should arrive at the total net decrease in cash for the company, which in fact we do. And you'll notice that this amount $3,318,000 negative is exactly equal to the difference between our starting cash at the beginning of the year and our ending cash at the end of the year. So this concludes our discussion on the statement of cash flows. In the next video, we're going to look at techniques to standardize our financial statements and consider how that can make it easier for us to interpret, analyze, and compare our financial data.